Here is a question with a surprising answer. What do these five people have in common? Warren Buffett, who built a $1 trillion company, buying undervalued businesses and holding them forever. Ray Dalio, who built the world's largest hedge fund by obsessing over economic cycles and building a portfolio designed to win in every season. Peter Lynch, who averaged 29.2% annual returns, managing the Fidelity Magellan Fund from 1977 to 1990, one of the best track records in investment history. By investing in businesses regular people understood from everyday life. John Bogle, who created the index fund and spent his entire career arguing that most investors should simply own the entire market and stop trying to beat it. Benjamin Graham, who invented the entire discipline of value investing, mentored Warren Buffett, and wrote the two most important investment books in history. Five completely different strategies. Five completely different personalities. Five completely different eras and markets. And yet, when you study their careers closely, they share the same six principles, the same mindset, the same emotional discipline, the same relationship with risk, the same understanding of time. This video identifies every principle they shared and shows you exactly how to apply each one inside a Canadian TFSA in 2026. Because here is the most important thing about all six principles. None of them require genius. None of them require exceptional intelligence. And none of them require large amounts of starting capital. They require something rarer than any of those things. And we will get to what that is. Here is the first principle. And it is the most counterintuitive thing about every single one of these legends. Not one of them was primarily focused on making money. They were primarily focused on not losing it. Warren Buffett's two rules of investing are famously simple. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Benjamin Graham introduced the concept of the margin of safety, buying stocks at prices significantly below their calculated intrinsic value to create a buffer against being wrong. Graham's foundational insight was that the essence of investment management is the management of risks, not the management of returns. Ray Dalio built his entire all-weather portfolio around the same principle. Design a portfolio that cannot be catastrophically wrong in any economic environment. His most famous quote on risk: "He who lives by the crystal ball will eat shattered glass." Dalio does not try to predict the future. He designs portfolios that survive every version of it. Charlie Munger, who spent decades as Buffett's partner, put it differently, but with the same core insight. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Avoiding errors beats chasing cleverness. Not doing dumb things repeatedly is a powerful compounding advantage. And Peter Lynch, despite running the most aggressive growth fund of his era, was obsessive about downside. His core framework: understand the downside scenario completely before considering the upside. Know what you own and why you own it, because investors who cannot explain why they own something cannot make rational decisions when the price falls. The common thread: every one of these legends understood that losses are mathematically more damaging than equivalent gains. A 50% loss requires a 100% gain to recover. A 33% loss requires a 50% gain. Asymmetric mathematics means protecting the downside is more important than maximizing the upside. The Canadian application, the TFSA, is the most powerful loss protection tool available to Canadian investors. Not because it prevents market losses, but because it eliminates the tax drag that compounds losses further in a taxable account. Every dollar of capital preserved inside a TFSA is a dollar that continues compounding tax-free. For most Canadian investors, owning a globally diversified ETF like XEQT eliminates the single stock risk that creates catastrophic losses. A portfolio holding 9,000-plus companies cannot be destroyed by the failure of any single business. The margin of safety is built into the structure. Your action step before your next investment. Ask Graham's question. What is the downside? What could go wrong? And at what price does this investment have a sufficient margin of safety that even the downside scenario is survivable? Here is the second principle, and the one that most clearly separates the legends from the rest. Every single one of them thought about investing in decades. Not quarters, not years, decades. Warren Buffett has held Coca-Cola shares since 1988, 38 years. He has held American Express since 1964, over 60 years. His famous quote on holding periods, "Our favorite holding period is forever." When asked what he would do if the stock market closed for 10 years, Buffett said he would be comfortable holding his current portfolio. Not because he did not care about price, but because he was buying businesses, not renting tickers. Charlie Munger's view, the first rule of compounding is never interrupt it unnecessarily. Benjamin Graham's core insight was that in the short run, the market is a voting machine, driven by popularity, sentiment, and noise. But in the long run, it is a weighing machine, measuring actual business value. Patient investors who ignore the voting machine and focus on the weighing machine are rewarded accordingly. Peter Lynch averaged 29.2% annual returns. But Lynch himself noted that the average investor in his fund, despite the fund's extraordinary performance, actually lost money during his tenure, because they bought after the fund ran up and sold when it fell. They had access to one of the greatest investors in history and made nothing from it, because their time horizon was days and weeks, not years and decades. The mathematics of time: $10,000 invested at 10% annual return. After 20 years, $67,275. After 40 years, $452,593. After 50 years, $1,173,909. The difference between 30 years and 50 years, adding just 20 more years, is nearly $1 million more from the same $10,000. No additional investment, just time. The Canadian application: a 25-year-old Canadian who opens a TFSA today and invests $7,000 per year at 8% annual return has 40 years until age 65. At 8% for 40 years, $7,000 per year becomes approximately $1,944,000. Tax-free. The same $7,000 per year starting at 45, only 20 years, produces approximately $320,000. The 20-year difference in start date produces a $1.6 million difference in final wealth. That is the time principle of every legend, applied to a Canadian TFSA. Your action step: write down your investment time horizon right now. If you are 28 years old, you have 37 years to age 65. That is not a short time. That is the most powerful compounding engine ever created. Here is the third principle, and it is the one most visibly violated by most investors every time a new trend emerges. Every single legend had a clearly defined circle of competence, and they stayed inside it ruthlessly. Warren Buffett famously avoided technology stocks for decades. When the dot-com bubble was inflating in the late 1990s, while everyone around him was getting rich on internet companies, Buffett was buying furniture retailers, insurance companies, and consumer goods businesses. He was ridiculed, said to have lost his touch. The dot-com crash of 2000 to 2002 wiped out trillions. Buffett, who stayed inside his circle, emerged dramatically ahead. His explanation: I do not need to know how a company will grow its earnings 5 years from now. I need to know that I can predict with high confidence that its earnings will be higher in 10 years than they are today. The circle of competence is not about intelligence, it is about honesty, knowing the precise boundary between what you understand and what you merely think you understand. Charlie Munger reinforced this from a different angle. Take a simple idea and take it seriously. Big outcomes come from disciplined execution of a few sound principles, not from brilliant complexity. Peter Lynch translated the circle of competence into actionable investing. Invest in what you know from everyday life. If you shop at a particular retailer and the store is always busy, the product is always improving, and the price seems like a bargain. That is an observable competitive advantage. Lynch discovered some of his best investments by noticing where his family spent money. Ray Dalio's circle was economic and macro cycles, the interplay between debt, growth, inflation, and central bank policy. Inside that circle, he was extraordinarily effective. Outside it, he would have been guessing. The most important application for most investors, John Bogle's entire thesis, was built on an honest assessment of most investors' circle of competence. Most people, including most professionals, do not have a reliable edge in selecting individual securities. The honest response is not to fake the expertise. It is to own the entire market at the lowest possible cost. For most Canadian investors, XEQT inside a TFSA is the investment that requires no expertise beyond understanding that economies grow over time and that fees reduce returns, and it produces results that 96% of actively managed funds cannot match after fees. Your action step: draw your circle of competence honestly. What businesses do you truly understand? Their revenues, their competitive advantages, their vulnerabilities. If the list is short, that is not a failure. It is honesty. And the index fund is the honest investor's answer. Principle 4. They treated market crashes as sales, not catastrophes. During the 2008 financial crisis, when the global financial system appeared to be collapsing, Warren Buffett wrote an op-ed in the New York Times titled, "Buy American, I Am." He was buying while everyone else was selling. He bought $5 billion of Goldman Sachs shares on September 23, 2008, in the middle of the worst financial crisis since the Great Depression, at terms so favorable that Berkshire ultimately earned approximately $3.7 billion on the investment. His reasoning was the same reasoning Graham had taught him 50 years earlier. When the price of a business falls dramatically below its intrinsic value, that is not a crisis. That is an opportunity. Buffett's most useful investing metaphor: imagine Mr. Market, a business partner who offers to buy your shares or sell you his every single day. Some days, Mr. Market is euphoric and names a ridiculously high price. Some days he is depressed and offers his shares at a bargain. Your job is not to follow Mr. Market's mood. Your job is to take advantage of it. Ray Dalio's framework: pain plus reflection equals progress. Every market loss, every mistaken prediction is data to be studied, not trauma to be recovered from. Peter Lynch: the person who turns over the most rocks wins the game. Continuous learning was not separate from his investment process. It was the investment process. John Bogle's discipline was simpler but equally demanding: staying the course. The stock market is a giant distraction from the business of investing. Research showed that investors who checked their portfolios least frequently produced the best long-term returns. Principle 5. They never stopped learning. Warren Buffett reads an estimated 500 pages per day. Charlie Munger read so voraciously that his children called him a book with legs. Ray Dalio writes detailed postmortems on every significant investment outcome. The investment world rewards the intellectually curious and penalizes the intellectually complacent. Markets evolve. The legends adapted, while staying anchored to their core principles. Your action step. Identify one investing book, podcast, or channel to engage with consistently, not to chase tips, but to deepen your understanding of how businesses, economies, and markets work. Here it is. The vault from the opening. The one trait that every legend shared. That is rarer than intelligence, rarer than capital, rarer than access to information. Emotional discipline under pressure. Not intelligence, not connections, not luck. The ability to maintain rational behavior when every psychological signal is screaming at you to do the opposite. Graham put it this way: the investor's chief problem, and even his worst enemy, is likely to be himself. Successful investing is not primarily an intellectual challenge. It is a psychological one. Here is the evidence. Dalbar, the investment research firm, publishes an annual quantitative analysis of investor behavior. Their findings year after year confirm the same pattern. The average investor dramatically underperforms the market they invest in. Not because of bad fund selection, but because of emotional timing decisions. In 2023, the S&P 500 returned 24.23%. The average equity fund investor captured significantly less because they sold during drawdowns and missed the recovery. In 2024, the S&P 500 returned 23.31%. The same pattern repeated. The market consistently produces excellent long-run returns. The average investor consistently captures a fraction, because fear causes selling at lows and greed causes buying at highs. Buffett on his own emotional discipline. I never attempt to make money on the stock market. I buy on the assumption that they could close the market the next day and not reopen it for 5 years. Munger's framework for avoiding emotional mistakes. Invert. Always approach a problem by thinking about what not to do. Invert. Always invert. If you understand all the ways an investor fails emotionally, you can systematically avoid each one. The 6 psychological traps every legend identified and avoided. Loss aversion. Feeling the pain of a loss twice as intensely as an equivalent gain. Recency bias. Assuming recent market behavior will continue. Herd mentality. Doing what everyone else is doing because it feels safer. Overconfidence. Overestimating your ability to predict market outcomes. Confirmation bias. Seeking information that confirms existing beliefs. Short-term thinking. Prioritizing how the portfolio looks today over where it is going in a decade. The Canadian application. The most powerful thing a Canadian investor can do to apply the emotional discipline principle is to remove the emotional variable entirely through automation. Automatic monthly TFSA contributions, regardless of market level, eliminate the emotional timing decision completely. DRIP on dividend ETFs eliminates the reinvestment decision. A pre-committed rebalancing schedule eliminates the temptation to react to headlines. The system replaces the emotion. And in investing, as every legend confirmed, the system always beats the emotion over long periods. Your action step. Identify which of the 6 psychological traps has cost you the most in your investing history. Then design one specific automatic rule that eliminates the opportunity for that emotion to act. Let's come back to where we started. 5 completely different investors. 5 completely different strategies. 5 completely different eras. Warren Buffett, Ray Dalio, Peter Lynch, John Bogle, Benjamin Graham. 6 principles they all shared. 1. They obsessed over not losing money. Downside first. Always. 2. They thought in decades, not days. The weighing machine rewards patience. The voting machine rewards nobody consistently. 3. They stayed inside their circle of competence ruthlessly. Knowing what you do not know is as powerful as knowing what you do. 4. They treated market crashes as sales, not catastrophes. Mr. Market is not your advisor. He is your counterparty. 5. They never stopped learning. The compounding of knowledge is as powerful as the compounding of capital. 6. And the one that overrides every other. They maintained emotional discipline under pressure. Not intelligence, not connections, not timing. Emotional discipline. For the average Canadian investor, applying all 6 principles requires exactly 4 things: a TFSA, a low-cost index ETF, an automated monthly contribution, and the discipline to never sell during downturns. That is it. The synthesis of Graham, Buffett, Lynch, Dalio, and Bogle, applied to a Canadian brokerage account, comes down to those 4 things. You do not need a Bloomberg terminal. You do not need a finance degree. You do not need $100,000 to start. You need the 6 principles. You need the emotional discipline to follow them. And you need to start today. Because the greatest advantage any of the legends ever had was not their intelligence. It was their time.